If you own silver ETFs, silver futures, or unallocated silver in a bank account, listen to me very carefully. You own nothing. You own a promise from a bankrupt counterparty. For every ounce of real physical silver in the COMEX vaults, there are upwards of 250 paper claims trading against it. It is the biggest game of musical chairs in financial history, and the music is about to stop. For decades, the financial world has operated under a grand illusion, a magic trick of epic proportions, designed to convince you that a digital entry on a screen is the same thing as a dense, lustrous bar of precious metal that you can hold in your hand. This illusion has allowed a small cabal of bullion banks to control the price of a critical global resource, suppressing its true value and enriching themselves at your expense. But like all magic tricks, it relies on misdirection and a willing suspension of disbelief. Once you understand how the trick works, you can never unsee it. And once enough people see it, the illusion collapses. To understand the scam, you must first understand that there is no single silver market. There are two, and they could not be more different. First, there's the physical silver market. This is the real world. It is mines digging ore out of the earth. It is refineries melting it down into 1,000-ounce industrial bars or 1-ounce retail coins. It is industrial giants like Tesla and Samsung buying tons of it to build electric vehicles and smartphones. It is you, the individual investor, buying a tube of American silver eagles and burying them in your backyard. This market is governed by the immutable laws of physics and geology. You cannot print physical silver. You cannot leverage it. It either exists in your possession or it doesn't. Then there is the paper silver market. This is the casino. This is where the spot price of silver that you see on CNBC or your trading app is determined. It takes place on futures exchanges like the COMEX in New York and the LBMA in London. In this market, billions of dollars change hands every day, but almost no physical metal ever moves. What trades here are not silver bars. They are futures contracts. A contract is a legal agreement to buy or sell a set amount of silver. But that legitimate purpose was long ago hijacked. Today, the vast majority of trading on the paper market has absolutely nothing to do with hedging physical metal. It is pure financial speculation. It is dominated by massive bullion banks, hedge funds, and high-frequency trading algorithms that will never mine a single ounce of silver and have zero intention of ever taking delivery of a physical bar. They buy and sell these paper contracts to bet on price movements, to arbitrage tiny price differences, and, most nefariously, to manipulate the perceived value of the metal. This is where the 250 to 1 scam begins. In the physical market, if you have 100 ounces of silver, you can only sell 100 ounces. You can't sell what you don't have. In the paper market, this rule does not apply. The exchanges allow participants to trade contracts representing vast amounts of silver with only a tiny fraction of the cash or physical metal required to back them up. This is called margin trading. You might only need to put down 5% or 10% of the contract's value to control 5,000 ounces of silver. This creates massive leverage. It means that for every dollar of real money in the market, there are $10 or $20 of paper silver exposure. But the leverage goes even deeper. The true heart of the scam is the disconnect between the number of paper contracts outstanding and the amount of physical silver actually held in the exchange's vaults to back them. This is known as the open interest versus the registered inventory. Open interest is the total number of futures contracts that have been bought or sold and are still active. It represents the total paper claim on silver. Registered inventory is the amount of physical silver bars sitting in COMEX-approved warehouses that are explicitly set aside to settle these contracts if someone demands delivery. In a sane and honest market, these two numbers would be roughly equal. Every paper claim would be backed by a physical ounce. But the silver market is neither sane nor honest. For years, the ratio of paper claims to physical silver has been wildly distorted. It is not uncommon for the open interest on the COMEX to represent 50, 100, or even more times the amount of registered physical silver available for delivery. Some analysts, by including unallocated bank accounts and over-the-counter derivatives, estimate the true leverage ratio across the entire global system to be as high as 250 to 1, or even 500 to 1. Think about what that means. It means that for every 250 people who think they own an ounce of silver through a paper contract or a bank account, there's only one physical ounce sitting in a vault to satisfy them all. Why would the regulators allow such a fraudulent system to exist? And who benefits from it? The primary beneficiaries are a handful of massive bullion banks who act as the primary market makers on the COMEX and LBMA. They are the house in this global casino. They use this massive leverage not just to make money on trading fees, but to actively suppress the price of silver. Why suppress it? There are many theories. Some believe it is done at the behest of central banks to maintain faith in fiat currencies like the US dollar. If gold and silver prices were allowed to skyrocket, It would be a blaring alarm signal that the currency is losing value. Others believe it is simply about greed. The banks have massive short positions and stand to lose billions if the price rises too high. Regardless of the motive, the mechanism is clear. Because they can create paper contracts out of thin air with massive leverage, they can flood the market with supply whenever the price starts to rise. Imagine a scenario where real-world demand for physical silver is surging. Industrial users are buying, investors are buying, and the physical market is tight. In a free market, the price would rise to balance this demand with the limited supply. But in the paper market, the bullion banks can simply sell thousands of futures contracts in a matter of seconds. This dumps the equivalent of millions of ounces of paper silver onto the market instantly. The trading algorithms see this massive surge in supply and immediately hammer the price down. It doesn't matter that no physical silver was actually mined or sold. The price on your screen drops. The illusion holds. This creates a bizarre reality where the spot price of silver has almost no relationship to the physical fundamentals of supply and demand. You can have record industrial demand, falling mine supply, and draining physical vaults, yet the paper price can go down because a few banks decided to sell a massive amount of paper contracts. This is the tail wagging the dog. The financial derivative is dictating the price of the real-world asset it is supposed to represent. The system of paper suppression is incredibly powerful. It has worked for decades to keep silver prices artificially low, often below the actual cost of mining it. It has allowed the financial elite to siphon wealth from producers and retail investors, but like all Ponzi schemes, it has a fatal flaw. It relies on one crucial assumption, that the vast majority of people holding paper contracts will never, ever ask for the actual silver. The entire scam is predicated on the fact that 99% of futures contracts are settled in cash. Traders buy a contract, hold it for a while, and then sell it before it expires, taking their profit or loss in dollars. They don't want 5,000-ounce bars of silver delivered to their doorstep. They are financial speculators, not metal merchants. As long as this remains true, the game can continue indefinitely. The banks can keep printing paper contracts, the leverage can keep growing, and the price can keep being suppressed. But what happens if that assumption changes? What happens if the people holding the paper decide they don't want cash anymore? What happens if they lose faith in the dollar or in the banks themselves and demand the only asset that has no counterparty risk, the physical metal? This is the nightmare scenario for the bullion banks. This is the bank run on the paper silver market. The contracts they sell are not just bets. They are legal obligations to deliver physical silver if the holder demands it. If a contract holder stands for delivery, the bank that sold the contract must provide the physical metal. They cannot pay them off in cash if the holder refuses it. Remember the math. 250 paper claims for every 1 physical ounce. If even 1% or 2% of the contract holders decided to stand for delivery in a single month, it would completely overwhelm the available physical inventory in the COMEX vaults. The banks would have to scramble to find physical silver on the open market to meet their obligations. But where would they find it? The physical market is tiny compared to the paper market. It is already tight, with industrial users gobbling up most of the annual supply. The banks would be forced to bid against each other for a scarce physical resource. This would send the price of physical silver skyrocketing. And this is where the illusion would shatter. The spot price on the screen might say silver is $25 an ounce. But if a bank has to pay a refinery $50 an ounce to get a physical bar to settle a contract, then the real price of silver is $50. This is the decoupling. The moment when the paper price and the physical price go their separate ways. The moment the 250 to 1 scam unravels. To understand what a silver squeeze looks like, we must look back to the most famous example in history. The 1979 to 1980 saga of the Hunt brothers. Nelson Bunker Hunt and William Herbert Hunt were Texas oil tycoons. 2 of the wealthiest men in the world at the time. They were terrified of the rampant inflation of the 1970s, which was eroding the value of their dollar-based fortune. They believed, correctly, that hard assets like precious metals were the only true hedge against currency debasement. They didn't just want to buy a few coins, they wanted to corner the market. Starting in the early 1970s, they began accumulating massive amounts of physical silver. By 1979, they and their partners controlled an estimated 100 million ounces of physical silver and held long futures contracts for another 100 million ounces. They had no intention of settling those contracts for cash. They intended to stand for delivery and take possession of the physical metal. As their buying pressure mounted and the market realized they were serious about taking delivery, the price of silver began to rocket. It went from around $6 an ounce in early 1979 to an all-time high of nearly $50 an ounce in January 1980. The bullion banks and brokerage houses that had sold them the paper contracts were facing annihilation. They didn't have the physical silver to deliver, and buying it on the open market at $50 an ounce would bankrupt them. The short sellers were caught in a death spiral. So, what happened? Did the free market play out? Did the Hunts become the new kings of silver? No, the rules were changed in the middle of the game. The financial establishment, the exchanges, the regulators, and the Federal Reserve colluded to stop the Hunts. The COMEX retroactively changed its trading rules. They imposed liquidation-only orders, meaning traders could only sell existing positions, not buy new ones. They drastically raised margin requirements, forcing the Hunts to put up hundreds of millions of dollars in cash they didn't have liquid. This forced the Hunts to begin dumping their silver to meet margin calls. The price collapsed from $50 back down to under $11 in a matter of months. The Hunts were ruined, eventually declaring bankruptcy. The banks were saved. The paper scheme was preserved. The lesson of 1980 is clear. The financial establishment will do whatever it takes, including changing the rules and colluding against investors to protect their rigged game. A squeeze led by a few wealthy individuals can be crushed. But the world of the 2020s is vastly different from the world of 1980. The forces aligning for a squeeze today are not a couple of Texas billionaires. They are decentralized, global, and crucially, industrial. First, let's talk about the retail investor. In 1980, information moved at the speed of a newspaper. Today, it moves at the speed of light. The internet and social media platforms like Reddit have democratized financial information and allowed millions of individual investors to coordinate their actions. We saw the power of this swarm in the GameStop short squeeze of 2021. A group of individual investors on the Wall Street Bets forum realized that hedge funds had shorted more than 100% of GameStop's available shares. They collectively bought the stock, forcing the hedge funds to cover their shorts at massive losses. In early 2021, this same energy turned towards silver. The silver squeeze movement was born. The thesis was simple: buy physical silver and force the bullion banks to deliver. While the initial attempt didn't break the COMEX, it had a profound impact. In a single weekend, virtually every online bullion dealer in the world was wiped out of physical inventory. The premiums on physical coins and bars, the price you pay above the paper spot price, skyrocketed to record highs. This proved a crucial point. The physical market is incredibly tight. It doesn't take much new demand to strip the shelves bare. While the banks could still print paper contracts to suppress the spot price, they couldn't print physical coins to meet the retail demand. The disconnect between paper and physical became undeniable to anyone paying attention. Since then, a dedicated community of silver stackers has continued to relentlessly accumulate physical metal, draining retail supplies month after month. They are not speculating on short-term price moves. They are removing physical inventory from the system permanently. They are slowly but surely bleeding the beast. But the retail investor, while powerful, is not the biggest threat to the paper scam. The ultimate catalyst for the great squeeze will come from the industrial sector. In 1980, silver's primary industrial use was photography. Today, it is the lifeblood of the modern high-tech economy. As we discussed, it is essential for solar panels, electric vehicles, 5G networks, and advanced electronics. Industrial demand is not speculative. A solar panel manufacturer like Jinko Solar or an electronics giant like Samsung does not buy silver hoping the price goes up. They buy it because they must have it to build their products. Their demand is price inelastic. If they can't get silver, their factories stop. Their stock price collapses. Their business dies. For decades, these industrial giants have played along with the paper market game. They have used futures contracts to hedge their price risk and have relied on the bullion banks to source their physical metal. They operated on just-in-time inventory systems, believing that physical silver would always be readily available at the paper price. But that confidence is eroding fast. The structural deficit in the silver market is becoming impossible to ignore. For 4 consecutive years, global demand has outstripped global supply by hundreds of millions of ounces. The only reason the system hasn't broken yet is that the world has been drawing down above-ground stockpiles from vaults in London and New York. But those vaults are emptying. Since 2021, the registered silver inventory on the COMEX, the silver available for immediate delivery, has plummeted by over 70%. It is at its lowest level in years. The industrial buyers see this data. They see the physical tightness. They are starting to realize that the paper market's promise of infinite liquidity is a lie. The trigger for the great squeeze will be the moment an industrial giant decides it can no longer take the risk of relying on the paper market. The moment a Tesla or an Apple decides it needs to secure a strategic stockpile of physical silver to ensure its production lines can keep running for the next year. Imagine if Elon Musk announced that Tesla was buying 50 million ounces of physical silver to secure its battery supply chain. He wouldn't buy paper contracts. He would demand physical delivery. 50 million ounces is more than the entire current registered inventory of the COMEX. A single order from a single industrial player could wipe out the entire available physical stock on the world's premier futures exchange. What happens then? The banks who sold the paper contracts would be in immediate default. They would have to declare force majeure, admitting they cannot deliver the metal. They would try to settle in cash, perhaps at a premium to the spot price. But what if the industrial buyer refuses the cash? What if they say, I don't want your fiat dollars, I need the metal to build my cars? Then the panic begins. Every other industrial user on the planet would see that the COMEX has failed. They would realize that their own paper hedges are worthless for securing actual metal. The FOMO, fear of missing out, would not be for profits, it would be for survival. A global scramble for physical silver would ensue. Industrial users would bypass the exchanges entirely, going directly to refineries and miners, bidding up the price of real metal in a desperate attempt to secure supply. The paper market would be revealed for what it is, a casino with no cash in the vault. The 250 paper claims would all be chasing that one physical ounce. This is the mechanism of the short squeeze. It is not a matter of if, but when. The geological reality of declining supply and the industrial reality of exploding demand are colliding with the financial fantasy of paper derivatives. The climax won't happen over weeks or months. It will likely happen in a matter of days, perhaps even hours. It will begin with a news headline that seems innocuous to the general public, but sends a shockwave of terror through the financial world. Something like, major industrial user demands physical delivery of 30 million ounces from COMEX. Exchange reports, logistical challenges. Logistical challenges will be the euphemism for, we don't have the metal. Behind the scenes, chaos will erupt at the bullion banks. The entities that are short billions of dollars in paper silver will realize they are trapped. They are legally obligated to deliver metal they do not possess and cannot source. As the news spreads, other holders of paper contracts, hedge funds, family offices, wealthy individuals will rush to stand for delivery, hoping to get their metal before it's all gone. It will be a classic bank run, but on a physical commodity. The COMEX registered inventory, already critically low, will vanish overnight. The exchange will be forced to halt trading. They will declare an emergency. They will likely implement the same playbook used against the Hunt brothers in 1980, changing the rules to liquidation only, raising margins to punitive levels, and attempting to force contract holders to accept a cash settlement. But this time, it won't work. Because this time, the biggest longs aren't speculators who can be bullied into taking cash. They are industrial users who need the metal to survive. A solar panel manufacturer cannot build panels with a cash settlement. They will refuse the cash and demand the metal, perhaps initiating massive lawsuits for breach of contract. This is the moment of the great decoupling. The illusion that paper silver and physical silver are the same thing will be shattered forever. On the frozen screens of the futures exchanges, the spot price might be stuck at $30 or $40 an ounce. It will become a zombie number, a relic of a broken system, representing a price at which no actual metal can be bought. Meanwhile, in the real world, the price of physical silver will be entering price discovery for the first time in decades. Bullion dealers, refiners, and miners will be inundated with panicked calls from desperate industrial buyers. Name your price, they will say. What is the price of silver when Apple needs it to launch its next iPhone and there is none available? What is the price when China needs it to meet its solar energy targets and the vaults are empty? It is not $30. It is not $50. It could be $100, $200, $500, or more. In a true shortage of an essential, non-substitutable industrial material, the price has no ceiling until it becomes high enough to destroy demand, meaning factories have to shut down. The premiums on physical retail silver, coins, and bars will explode. You might see a spot price of $40 on TV, but if you walk into a coin shop, a 1-ounce silver eagle might cost you $150 if they even have any to sell. The premium will no longer be a small percentage over spot. It will be the majority of the price, reflecting the true value of the physical asset versus the worthless paper promise. The paper market will effectively go to zero. The trillions of dollars in derivative notional value will evaporate. The ETFs that claim to hold silver but are structured with loopholes allowing them to pay in cash or use unallocated metal will be exposed. Investors who thought they owned silver through paper vehicles will find themselves holding empty bags, likely receiving a cash payout based on the last zombie spot price, pennies on the dollar compared to the real physical value. The collapse of the paper-silver scam will have profound consequences beyond the metals market. It will be a massive wake-up call about counterparty risk throughout the entire financial system. If the banks could lie about their silver reserves for decades, what else are they lying about? What about paper gold? What about unallocated bank deposits? Trust in the financial establishment will be shattered. Capital will flee paper promises and seek the safety of bearer assets, assets you hold in your hand, that have no counterparty, and whose value does not depend on a bank's solvency. Physical gold and silver will be the primary beneficiaries of this flight to safety. For the silver market itself, it will be a total reset. The power to set the price will shift from the speculators on Wall Street back to the producers and consumers in the real world. Mining companies, long abused by artificially low prices, will suddenly become enormously profitable strategic assets. National governments, realizing the critical importance of silver for national security and their green energy transitions, may move to nationalize mines or restrict exports. Silver will be treated not as a speculative toy, but as a strategic resource on par with oil or uranium. For the industrial users, the era of cheap silver is over forever. They will have to enter into long-term offtake agreements directly with miners, paying a significant premium to ensure supply. The cost of everything from electronics to solar panels will rise, reflecting the true scarcity of the metal that makes them possible. And what about you, the individual investor? If you are holding paper silver when the music stops, SLV shares, unallocated pool accounts, futures contracts, you are the one left without a chair. You will be a creditor to a bankrupt institution. You will learn a harsh lesson about the difference between ownership and a claim. But if you are holding physical silver, the real metal in your own possession, you will be one of the few who prepared for reality. You will hold an asset that is suddenly in desperate global demand. You will have preserved your wealth outside of a fraudulent system. The 250 to 1 paper-silver scam is the greatest lie in modern finance. It is a towering edifice of fraud built on a foundation of sand. The geological reality of declining supply and the industrial reality of exploding demand are the tides that are washing that sand away. The squeeze is coming. The decoupling is inevitable. The only question is, which side of the trade will you be on when the illusion finally breaks? Will you hold the paper promise, or will you hold the physical truth? The choice is yours, but time is running out.